Welcome to our tax-saving video series for tech and real estate entrepreneurs, where you'll discover valuable tips for business growth. With your host, Sammy Basta, CPA.
Hey there, today we're diving into a crucial topic that could save you thousands in taxes or cost you big time if you're not careful. We're talking about real estate tax professional status, or REPS for short. So what's REPS? REPS is a special tax status that can make a huge difference in how your rental property losses are treated on your tax return. But here's the kicker: the rules are different at the federal level and in California. So let me break it down for you. The good news at the federal level is REPS is like a golden ticket. If you qualify, you can treat your rental property losses as active income. This means that you can use those losses to offset your other income, like your day job earnings. And in order to qualify for REPS at the federal level, you need to meet two key requirements. First, you need to spend at least 750 hours working in a real property trade or business. Second, you need to spend more time working in real property trade or business than you do anywhere else. But you also must demonstrate material participation in your rentals, which is usually not a big issue if you're a full-time landlord. So here's a quick example. Let's say you have a rental property that lost $20,000 this year. You also made $100,000 at your day job. With the federal REPS, you could reduce your taxable income to $80,000, and that's a significant tax saving. Here's when it gets tricky. California doesn't play by the same rules. In fact, they're explicitly rejected REPS in their tax code, California Revenue and Taxation Code, section 17561A states that section 469C7 of the Internal Revenue Code relating to special rules for taxpayers in real property business shall not apply. So what does this mean? It means that in California, all rental activities are considered passive, no exceptions. So that $20,000 loss we talked about, it stays locked in the passive income tax box. You cannot use it to offset your job income or any other active income. In fact, the California Franchise Tax Board, FTB, makes that crystal clear in their instructions on Form FTB 3801, the passive activity loss limitations. It says that for California purposes, all rental activities are passive activities. Therefore, an election under RC section 469C7 is inapplicable for purposes of California personal income tax or franchise tax. The bottom line here is this difference can mean potential paying a lot more in state taxes in California. So while you might see a nice federal tax break, your California tax bill wouldn't budge. So what this means for you if you're a real estate investor in California? Well, first you need to be aware of those crucial differences. Your federal and state taxes strategies might need to be different, and you also can still qualify for a real estate professional at the federal level and claim those benefits, the tax losses in your 1040. However, these benefits wouldn't flow through to your California tax return. This applies even if your rental properties are located in California. So how does that impact your taxes? Well, California's stance on REPS can significantly reduce your total tax benefit by not allowing those losses from the rental to offset your income on your state taxes. So you might end up with a higher state tax bill than you expected. So to wrap it up here, remember, qualifying as a real estate professional is hard work and the rules are complex. This video is just an intro to this topic. So you want to always consult with a qualified tax professional who understand both the federal and the California specific real estate tax laws. And if you're investing in California real estate or living in California while investing elsewhere, it's crucial to factor in these specific rules, state rules, when planning your investment strategy and calculating your potential return. With that, I want to thank you for watching, and I'll see you next time.
This has been another episode of our tax-saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bastacpa.com. Thanks for listening, and have a great day.